In today's video, I'm going to teach you how to handle a line of credit in QuickBooks Online. We'll walk through how to set it up, how to record money you draw from it, and how to properly enter payments so both your loan balance and your interest expense are accurate. Let's start by setting up the line of credit account. In QuickBooks Online, go to the gear icon in the upper right and choose Chart of Accounts. This is where all your accounts live, including bank accounts, credit cards, income, and liabilities. Once you're there, click the New button to create a new account. For the account type, open the drop-down and select Other Current Liabilities. This tells QuickBooks that this is money your business owes and expects to pay back in the near term. Next, choose a detail type. If you see Line of Credit, select that. If not, you can use Loan Payable instead. Both will work. The key is that it's a liability. Now, give the account a clear name, like Line of Credit Liability, so you and anyone else looking at your books will recognize it right away. When you're done, click Save. While you're in your chart of accounts, it's also a good idea to create a separate expense account just for interest, often called Interest Paid. This will keep your interest cost clearly separated from the principal you owe. Next, let's record draws from your line of credit. When your bank advances money from the line of credit into your checking account, you'll record it in QuickBooks as a deposit going into that checking account. On the deposit screen, in the category column, choose the line of credit liability account you just created. That tells QuickBooks this isn't income, it's borrowed money. After saving the deposit, your checking account balance will go up, and your line of credit liability balance will increase by the same amount. Finally, let's record payments back to the line of credit. When you make a payment from your business checking account, create a check or expense transaction for that payment. Here's the important part. You need to split the payment between principal and interest. The principal portion, the amount that actually reduces what you owe, should be categorized to your line of credit liability account. The interest portion should be categorized to your interest paid expense account. Saving the transaction this way makes sure your liability goes down correctly over time and your interest expense is tracked accurately on your profit and loss, giving you a clear picture of both your debt and the true cost of borrowing.